Imagine holding a button that could crash the global economy. A button so powerful that pressing it would send markets into freefall, spike interest rates, and rewrite world history overnight. Now imagine this twist. The moment you press that button, you die too. That's the real story behind China's $3.2 trillion in US dollars. Not a weapon, not leverage, a trap. For years, headlines have warned China could dump US debt and destroy America. Politicians whisper about it. Markets flinch at the rumor. Commentators call it the financial nuclear option. But here's the secret nobody wants to say out loud. China can't pull that trigger. Not won't, can't. Because the moment they try, the blast doesn't travel across the Pacific. It detonates inside China first. And that's what makes this so disturbing. Two superpowers, two economies bigger than most of the world combined, locked into a financial structure where any aggressive move guarantees mutual destruction. This isn't a rivalry, it's a hostage situation. China holds trillions in dollar assets. The United States depends on foreign buyers to finance endless debt. Each side knows exactly how fragile the other is, and each side knows that forcing the issue collapses everything. Here's where it gets darker. This trap wasn't created by accident. It was built slowly, quietly, over 40 years through trade deals, cheap labor, cheap money, and political convenience. China exported. America consumed. Dollars flowed east. Treasuries flowed west. Everyone won. Until they didn't. Today, China officially holds around $731 billion in U.S. Treasuries. That number alone sounds terrifying, but it's just the surface. Underneath it sits something far larger. Corporate bonds, mortgage-backed securities, equity stakes, dollar reserves sitting idle but exposed. Add it all together and you get the number that matters. Roughly $3.2 trillion tied directly to the US dollar system. That money isn't sitting in a vault. It's woven into China's banking system, its corporate debt, its currency stability, its export engine. Which means China doesn't own $3.2 trillion the way an investor owns cash. They're embedded in it. This is where the conspiracy-adjacent part comes in. Because publicly, both governments pretend this isn't happening. China talks about diversification, the US talks about confidence in markets. But behind closed doors, everyone understands the same nightmare scenario. If China sells too fast, markets panic. If markets panic, yields explode. If yields explode, the US financial system seizes. And if the dollar collapses, China's remaining trillions collapse with it. So the supposed weapon turns inward. Losses stack. Banks wobble. Exports freeze. Social stability cracks. That's why nothing dramatic ever happens. No big sell-off. No sudden collapse. Just slow, almost invisible movement. And that's the most dangerous part. Because traps don't need explosions to work. They only need time. In the next part, I'll show you exactly how China ended up here, step by step, how trade surpluses turned into dollar dependence, and why escaping this system is far harder than entering it. And once you see that mechanism clearly, you'll understand why this standoff isn't temporary, it's structural. Here's the uncomfortable truth most people miss. China didn't choose to build a $3.2 trillion position. It was forced into it by success. Every trap begins as an advantage. Go back to the 1980s. China opens its economy. Cheap labor, massive population. Factories explode across the coastline. The world floods in orders. Electronics, clothes, machinery. Everything with a barcode and a Made in China label. And here's the key detail almost nobody talks about. Those global buyers didn't pay China in yuan. They paid in US dollars. So Chinese exporters collected dollars. They couldn't legally keep them. They had to hand them to Chinese banks. Those banks passed them to the People's Bank of China. Suddenly, China's central bank wasn't planning industrial policy anymore. It was drowning in dollars. What do you do with trillions in foreign currency? You can't leave it as cash. Cash rots from inflation. So you invest it. And there was only one place deep enough to absorb that volume: US Treasuries. Safe, liquid, trusted, backed by the US government's taxing power. But here's the part that turns success into a cage. Every time China bought treasuries, it sold yuan and bought dollars. That kept the yuan artificially weak. A weak yuan made Chinese exports cheaper. Cheaper exports meant more sales. More sales meant more dollars. A perfect loop. China's entire growth model locked into this cycle. Export goods, earn dollars, buy treasuries, weaken yuan, export more goods. This is why the $3.2 trillion isn't money on the side. It is the economic model. 40 years of growth compressed into dollar assets. And here's where the illusion breaks. People imagine China could just switch currencies. But if China stopped buying treasuries suddenly, the yuan would surge. Exports would become expensive overnight. Factories would lose contracts. Unemployment would spike. So China was forced to keep playing the game, even after they realized it was dangerous. By 2008, the warning signs were impossible to ignore. The global financial crisis showed what dollar-based systems do under stress. Lehman collapsed. Mortgage securities detonated. The Fed printed trillions. China watched all of this while holding massive US mortgage-backed securities themselves. That was the moment Chinese leadership understood the nightmare. They weren't just exposed to the US economy, they were dependent on its stability. From that point on, China started planning an escape. Quietly, slowly, without alarming markets. They reduced treasury purchases. They diversified into other assets. They began stockpiling gold. But here's the catch. You can't unwind a 40-year position in 5 years. Or 10. Try to exit too fast and you trigger the very collapse you're trying to avoid. That's why the idea of China dumping everything is fantasy. It assumes China controls the timeline. They don't. Markets control the timeline. Confidence controls the timeline. Fear controls the timeline. And fear moves faster than policy. This is why the trap deepens instead of loosens. Every year China holds the dollars, risk grows. Every year they try to sell slowly, exposure remains. They're not choosing between good and bad options. They're choosing between slow suffocation and sudden collapse. And the US knows this, which is why Washington can't fully weaponize the dollar against China. Freeze assets, sanction reserves, cut off payment systems. Those tools work on countries without leverage. China has too much leverage. Push too hard, and China has nothing left to lose. This is where the standoff truly forms. Not military, not ideological, financial. Two economies roped together. Neither can jump, neither can climb fast enough. In the next part, I'll walk you through the exact nightmare scenario everyone fears. What actually happens if China tries to dump treasuries step by step, and why the first economy to collapse wouldn't be America. Let's walk through the nightmare everyone talks about, but almost no one actually understands. Picture this. No warning, no speeches, no press leaks. China issues one order. Sell everything. Hundreds of billions in US treasuries flood the market at once. Not slowly, not diplomatically, all at the same time. And here's the first misconception. People assume the US could handle it. It couldn't. The Treasury market is liquid until it isn't. Dumping over $700 billion instantly would overwhelm buyers. Prices would fall hard. And when bond prices fall, yields explode. Interest rates spike in minutes, not months. The 10-year Treasury jumps. Mortgage rates follow. Corporate borrowing costs surge. Housing freezes. Nobody buys. Prices collapse. And remember, consumer spending is most of the US economy. When home values fall, confidence evaporates. Spending drops. Businesses cut jobs. But that's just the opening shock. Banks hold treasuries as risk-free assets. When their value collapses, balance sheets crack. Credit tightens. Liquidity disappears. At that point, the Federal Reserve has only one option: intervene. They buy the bonds China is dumping, hundreds of billions, maybe more, which means printing money at a scale that makes past crises look small. Inflation reignites. The dollar weakens globally. Imports get expensive. Energy, food, electronics, everything spikes. This is where most analysis stops. China destroys the US economy. Except that's only half the story. Because while all this chaos hits America, something even worse is happening in Beijing. The moment the dollar starts falling, China's remaining dollar assets implode in value. Corporate bonds, mortgage securities, equity holdings, cash reserves. A 30% dollar drop wipes out hundreds of billions instantly, and China can't print dollars to cover the loss. Their central bank balance sheet shrinks overnight. Foreign exchange reserves meant to stabilize the yuan suddenly aren't enough. Then the second wave hits: exports. The US is China's biggest customer. When the US economy contracts, American consumers stop buying. Orders disappear. Factories slow, then shut down. But here's the killer detail. As the dollar falls, the yuan rises. That makes Chinese goods more expensive globally. So even countries outside the US buy less. China loses demand and competitiveness at the same time. And it doesn't end there. Chinese companies borrow in dollars because dollar rates are usually cheaper. When US rates spike and the yuan strengthens, that debt explodes in real terms. Revenues are in yuan. Debt is in dollars. The mismatch becomes fatal. Defaults spread. Banks take losses. Confidence breaks. Now China faces its own banking crisis without a reserve currency to print. And energy? China imports most of it. Oil, gas, coal priced in dollars. A collapsing dollar doesn't mean cheap energy for China. It means more yuan per barrel as currency volatility explodes. Energy costs surge. Inflation spikes. Social pressure rises. So step back and look at the full picture. China pulls the trigger. The US economy goes into crisis, but China detonates faster. That's why the so-called financial nuclear option is a myth. It's a suicide pact, and both sides know it. Which is why China never dumps. They bleed exposure slowly, quietly, month by month. And why the US never pushes China too hard, because retaliation wouldn't be clean or contained. This isn't about who would win a financial war. It's about who collapses first. In the next part, I'll show you what China is doing instead, the slow escape plan most people never notice, and why it takes decades, not years. China understands one thing perfectly. There is no dramatic escape. No press conference. No sudden sell-off. No clean exit. Only erosion. So instead of detonating the system, China chose a different strategy: disappear from it slowly. The first pillar of that plan is something ancient and deliberately quiet: gold. Not paper golds, not ETFs, physical metal. For years, China has officially reported modest increases in gold reserves, a few tons here, a few tons there. But insiders know that's theater. Gold doesn't move through press releases, it moves through shipping manifests, refinery flows, and central bank vaults. Since the aftermath of the 2008 crisis, China has been accumulating gold aggressively, both at the central bank level and through state-linked entities. Why gold? Because gold has no counterparty, no issuer, no sanction switch, no interest rate risk. If the dollar fractures, gold doesn't default. But gold alone can't absorb trillions. Buy too much, too fast, and prices explode. Markets notice, questions get asked. So gold accumulation stays slow, measured, unannounced. The second pillar is more modern and more dangerous: alternative payment systems. The dollar's real power isn't paper, it's plumbing. SWIFT, clearing banks, settlement systems. Control the pipes and you control global trade. China saw what happened when Russia's dollar reserves were frozen. Money that belonged to Russia suddenly didn't. That was the warning shot. So China built its own pipes, a parallel system designed to move money without touching the dollar at all. It's not meant to replace SWIFT overnight. That would trigger panic. It's meant to exist quietly, growing in the background. Every transaction settled outside the dollar is one less reason to hold dollars. And then there's the third pillar, the hardest one: internal consumption. For decades, China relied on exports: sell to the world, earn dollars, reinvest abroad. Now they're trying to flip the model. More domestic spending, more services, higher wages, less dependence on foreign buyers. On paper, this sounds like freedom. In reality, it creates new problems. Rising wages make exports less competitive. Factories relocate. Trade surpluses shrink, which means fewer new dollars coming in. That helps eventually, but it does nothing about the dollars already trapped in the system. This is the cruel irony. Every strategy China uses to escape the dollar slows growth, reduces competitiveness, and increases internal pressure. Escape isn't free, it's expensive. And while China moves slowly, something else is happening on the other side of the Pacific. The US isn't standing still. Debt keeps growing, deficits keep expanding, interest costs keep rising. The dollar isn't under attack, it's being worn down from within. So now the race is on. Can China diversify fast enough before the dollar system destabilizes on its own? Because if the dollar collapses before China escapes, China eats the losses anyway. This is the part nobody wants to confront. China can't sell, but it also can't afford to hold forever. That's the real trap. In the next part, I'll break down the timeline, how long this escape realistically takes, and why the clock is moving faster than policymakers admit. Here's where the story stops being theoretical and starts becoming terrifying. Because traps don't care about intentions, they care about timing. China didn't start preparing in 2020 or 2015. They started in 2008. That was the moment the illusion cracked. 17 years later, what do we see? Treasury holdings cut nearly in half from their peak. Gold reserves officially multiplied. Yuan settlement in global trade climbed from almost nothing to measurable. That sounds like progress, until you look at the math. At the current pace, it takes 2 to 3 more decades for China to reduce dollar exposure to a level that isn't lethal. 2 to 3 decades. Now compare that to the other clock. The US is adding debt faster than any empire in history outside of wartime. Interest payments are consuming a growing share of federal spending. Every crisis is met with the same solution: print, borrow, defer. The dollar doesn't need an enemy to fail. It only needs arithmetic. This creates a brutal mismatch. China needs time. The dollar system is running out of it. This is why markets feel unstable even when nothing dramatic happens. Everyone senses the imbalance. Central banks quietly reduce dollar share. Bilateral trade agreements bypass the greenback. Gold flows east. Nothing explosive, just erosion. And erosion has a breaking point. Historically, reserve currencies don't collapse slowly forever. They drift. Then they snap. Confidence is nonlinear. Once enough participants believe the exit is crowded, they rush for the door. China knows this, which is why they can't be the one to move first. If China accelerates selling, markets interpret it as panic. The US interprets it as attack. Sanctions follow. Access closes. China loses more from retaliation than from holding dollars. So they wait. And the US waits too, because Washington understands something equally dangerous. China's dollar holdings are a deterrent. Freeze them and China has nothing left to protect. Cut them off and escalation becomes inevitable. This is why financial weapons are used selectively, why rhetoric is loud but actions are careful. Both sides are buying time, but time is the one resource neither side controls. And that leads to the most uncomfortable question of all. What breaks first? China's patience, America's creditworthiness, or global confidence itself? In the next part, I'll show you why the US is trapped too, why America can't fully weaponize the dollar against China, and how this silent standoff limits US power more than anyone admits. Here's the twist almost no one in Washington likes to admit. The dollar isn't just a weapon, it's also a hostage. Yes, the US controls the reserve currency. Yes, it controls sanctions, clearing systems, and global settlement. But that power only works under one condition. The world must keep believing the dollar is neutral enough to hold. The moment the dollar looks like a political weapon instead of a financial utility, its greatest strength turns into its greatest weakness. This is why the US can't treat China the way it treated smaller countries. Sanction Iran? The system barely notices. Freeze Russian reserves? Shockwaves, but contained. Do that to China? That's not enforcement, that's detonation. China isn't just a country holding dollars, it's embedded inside the system. US Treasuries sit on Chinese balance sheets. Chinese factories sit inside American supply chains. American corporations depend on Chinese manufacturing. Pension funds depend on stable treasury markets. You don't punish China without punishing yourself. And here's the deeper problem. If the US freezes China's reserves, every central bank on Earth asks the same question. If it happened to them, could it happen to us? The answer would be yes. At that moment, holding dollars stops being prudent and starts being reckless. That's how reserve currencies die, not from inflation alone, but from loss of trust. This is why the US response to China is strangely constrained. Loud speeches, tariffs, technology restrictions, but not the nuclear financial options. Because the US knows once the dollar is seen as a weapon first and money second, diversification becomes urgent, not optional. And diversification is irreversible. Once a country builds non-dollar trade routes, it never fully goes back. So America is trapped in its own success. To maintain dollar dominance, it must act restrained. To act restrained, it must tolerate rivals. To tolerate rivals, it must accept erosion. This is the paradox of empire. Maximum power creates maximum fragility. And while policymakers debate strategy, the system keeps aging. Debt compounds. Interest costs rise. Political consensus fractures. Every shutdown, every debt ceiling crisis, every monetized deficit chips away at the same foundation: confidence. This is why the real battle isn't China versus the US. It's time versus credibility. China is racing to reduce exposure before confidence snaps. The US is racing to keep confidence intact before arithmetic overwhelms it. Neither side can sprint. Both are jogging toward a cliff they didn't design. In the final part, I'll pull back the camera, what this silent standoff means for the rest of the world, for smaller countries, for ordinary people, and for anyone trying to protect their future inside a system built on debt. Now zoom out, because this standoff was never really about China or the United States. It was about everyone else caught in between. When two giants are locked together by debt, the shockwaves don't hit them first, they hit the edges. Smaller countries, emerging markets, ordinary people. Here's how it actually plays out on the ground. When confidence in the dollar wobbles, even slightly, capital runs home. Money flees risk. Currencies and weaker economies fall first. Food prices rise. Fuel costs jump. Debt denominated in dollars becomes heavier overnight. A loan that was manageable suddenly isn't. This is why crises always look local at first. A currency crash here, a banking panic there, a balance of payments problem somewhere else. But they're all symptoms of the same core issue. A global system built on one currency supporting too much debt for too long. China feels it, the US feels it, but countries without leverage feel it hardest. And then there's the individual level. Because here's the truth nobody likes to say plainly. Most people don't lose in financial resets because they're stupid. They lose because they're positioned wrong. They hold assets that depend entirely on stability in a system that's becoming structurally unstable. They assume pensions will be paid as promised, savings will hold value, currencies will behave normally. But history doesn't work like that. When confidence breaks, it doesn't ask permission, it reprices everything. This is why the real divide in the coming years won't be rich versus poor. It will be aware versus unaware. Those who understand how the system works don't panic early. They diversify quietly. They avoid concentration risk. They think in decades, not headlines. Not by predicting collapse, but by acknowledging fragility. And here's the final uncomfortable realization. There is no villain behind the curtain, no single mastermind. Just incentives compounding over time. The US didn't plan to drown in debt. China didn't plan to be trapped in dollars. The world didn't plan to rely on one currency. But once a system works, everyone leans on it until it works too well. That's where we are now. A system that can't be exited quickly, can't be reformed cleanly, can only be adjusted slowly while stress builds quietly underneath. So the real question isn't, will the system collapse? It's, how do you live intelligently inside a system that no longer offers certainty? That's the question every government, institution, and individual is now answering whether they realize it or not. And that's why understanding this story matters. Not to scare you, not to sell you fear, but to remind you of one thing history teaches relentlessly. Those who see the structure early don't need to run when it finally shakes.